Trez Capital, Senior Managing Director, Originations. So I run the originations team for Trez Capital across Canada. I think spreads are going to be driven in large part by lender, the amount of liquidity in the market amongst lenders. And as we see the narrative around real estate improves, we're going to see added liquidity come into the market. I think banks, credit unions, private lenders are going to continue to increase their allocations towards capital in real estate. And as there's going to be a chase, investors are going to chase yield in the market. And that's going to drive capital into real estate, and specifically debt funds and REITs. And as a result, we're going to see increased competition, and that's going to drive down credit spreads in the market. I just don't think there's enough opportunities in the near term relative to the amount of capital that's going to come in to satisfy lenders. And for that reason, we'll see spreads decrease. Exiting 2025, I do see spreads starting to widen a bit, and I think that's a reflection of future opportunities in the market. Again, as the narrative increases, or improves, I should say, around real estate, particularly in the GTA, and we see more opportunities for lenders to deploy capital, we'll start to see fewer lenders chasing fewer deals and having more opportunities to deploy that capital. And that should allow spreads to continue to widen. I'd also say we might see a divergence between private lenders and more conventional lenders. Late in 2025, it's widely understood that prime rates will continue to drop in 2025, and typically private lenders have a minimum hurdle rate they need to achieve to attract inbound capital and make the return targets for the investors. If prime drops below the floor that they need to achieve, I think the private lender rates are going to be a bit stickier than the conventional. Conventional cost of funds are typically correlated to prime rate, and as a result, I think you're going to see a widening of spreads between the privates and the conventionals in the market in 2025, particularly late in the year. I think in the multifamily rental space, we're going to see a shift in the lending environment. CMHC currently has a disproportionate share of the construction lending market, and I do think that's going to change as we enter 2025. The value proposition for CMHC construction financing is changing, and it's causing borrowers and developers to look to alternatives. CMHC is very much a cost-effective alternative, but they have made changes. You look back to 2023 when the insurance premiums were increased. This year they've made changes to their policies, the application of certain policies that were previously ignored or not applied. Timelines to approval are longer. The outcome of the approval process is uncertain for certain borrowers. There's new covenant and guarantor requirements that CMHC is now mandating in some of their loans. And we've been hearing from the market that they may in fact be layering on additional changes. What is a rental achievement holdback, where construction loans are being right-sized to 75% or so loan to cost, with the additional leverage only available once the project completes and is stabilizing and certain rental milestones are being met, and that additional leverage. So it's a long way of saying that there's a lot of change with CMHC, and I think lenders such as Trez Capital, with our more conventional rental construction program, stand to benefit from some of these changes and provide a very good alternative for borrowers in the market. I would say that going into 2025, lenders are going to continue to be cautious. They're already cautious today, and that's going to continue. There's a lag effect from the current market cycle, hopefully soon to be over market cycle. You had high interest carry costs, you had rampant construction cost escalation. A lot of that is still weighing on credit decisions amongst lenders, and they're looking back rather than forwards to inform their lending policy. And I think as we move through the year, that's going to shift. And there's a geographic effect to this as well. Alberta, on the residential side, outperformed the rest of the country. It was by far and wide the strongest market in 2024 and 2023, and as a result, they benefit from disproportionate amount of lender capital. The historically strong and large markets for Metro Vancouver and the GTA, there wasn't nearly the opportunities for lenders to deploy money and loans in those markets than prior years. And as a result, you had Alberta receive, it was very competitive in that market. Spreads narrowed. It was very much a borrower's market, where borrowers were able to dictate terms to lenders, and it was to their benefit. I would say though that that's going to shift, hopefully in 2025, as we see the markets come around in the GTA and Metro Vancouver, and there's more opportunities for lenders. So you'll have a dispersion of capital across the entire country, as opposed to the disproportionate weighting that we may have seen in Alberta. To be patient. Lenders are still, a lot of their policy is informed by last year and the previous market cycle. We're asking a lot of borrowers today, and we're asking for a lot of information. Terms aren't what they were 18 or 24 months ago. I do think that will change. They just need to be patient and work with their lenders, and I think there'll be easier times ahead as there's more liquidity that enters the market, and the overall sentiment among lenders improves.